A moment that's already been called a milestone in transatlantic relations. President Trump and UK Prime Minister Starmer just signed what Starmer described as a groundbreaking new UK-US tech prosperity deal. That is the official name of the agreement.
Imagine a world where deals worth billions of dollars are made in conference rooms most of us will never enter. A world where companies can disappear overnight, swallowed by larger giants, and where entire industries are reshaped with a single signature. Corporate takeovers are not just business transactions, they are strategic battles for power, influence, and control. Today, we're diving into the hidden, high-stakes world of billion-dollar acquisitions, revealing the strategies, risks, and secrets that corporations don't want you to see. At the heart of corporate takeovers is the simple concept of control. Every company has a value beyond its physical assets, its brand, intellectual property, market share, and even its workforce. Larger corporations see this value and move strategically to acquire it, often paying far more than the tangible assets alone would suggest. These acquisitions are rarely about the short term. They are long-term plays to dominate markets, eliminate competition, or acquire crucial technology. Understanding this is the first step to grasping why corporate takeovers have become a central feature of the global economy. One of the most common methods of corporate takeover is the hostile acquisition. Unlike friendly mergers, where both companies agree on terms, hostile takeovers are aggressive. The acquiring company makes an offer directly to shareholders, bypassing management, and often creating tension, media buzz, and uncertainty. Hostile takeovers are high-risk, high-reward maneuvers. If successful, they can catapult a company into new markets almost overnight. But they also come with the danger of mismanagement, cultural clashes, and massive debt burdens. Despite the risks, some of the most famous corporate battles in history have been hostile takeovers, and they continue to reshape industries today. On the other hand, there are friendly mergers, which appear cooperative but are equally calculated. In these cases, both companies see mutual benefit combining resources, talent, and market influence. While less dramatic than hostile takeovers, friendly mergers can create monopolistic power, allowing the combined entity to control pricing, supply chains, and innovation. These mergers often receive far less media attention, but their impact on markets can be even more profound, quietly consolidating wealth and influence behind closed doors. The financial machinery behind corporate takeovers is astonishing. Leveraged buyouts, or LBOs, are a favorite tool. In an LBO, the acquiring company borrows huge sums, often using the target company's own assets as collateral. This strategy allows corporations to execute billion-dollar takeovers with relatively small amounts of their own cash. While the method is legal and often highly profitable, it can leave the acquired company heavily indebted, putting immense pressure on management and employees. LBOs are essentially high-stakes, financial chess, where every move must be carefully calculated, and the cost of misstep can be catastrophic. Investment banks and private equity firms play a massive role in these deals. They advise companies, structure financing, and sometimes even orchestrate takeovers themselves. These institutions operate in a world few outside the industry ever see, moving money, influence, and information at lightning speed. They earn billions in fees and commissions while shaping the global corporate landscape. The presence of these financial powerhouses often determines whether a takeover succeeds or fails, highlighting that corporate acquisitions are as much about strategy and connections as they are about money. Corporate takeovers are also about timing and opportunity. Companies look for targets that are undervalued, mismanaged, or strategically positioned. A company may have revolutionary technology, but if management fails to capitalize on it, an acquiring firm will step in. Conversely, a company may dominate its industry, but struggle financially, making it vulnerable to a takeover bid. The dynamics are complex. Investors, boards, and even regulators play roles in determining outcomes. Timing is everything, and the right move at the right moment can create instant billions in value. Media and public perception are surprisingly important in this world. A takeover can affect stock prices before it even happens, and rumors alone can spark dramatic market movements. CEOs and boards often use press releases, strategic leaks, and public statements to sway investors and gain leverage. This element of psychological strategy, managing perception while executing a financial maneuver, is one of the hidden arts of corporate takeovers. In many ways, it's a game of influence as much as it is a game of numbers. Technology has dramatically changed the takeover landscape. In the past, deals were slow, negotiations private, and information scarce. Today, advanced analytics, AI-driven market analysis, and global communication networks allow companies to identify targets faster, assess risks more accurately, and execute deals more efficiently. Technology doesn't just change the mechanics, it shifts power. Corporations that can harness these tools often gain an edge over rivals, making the difference between a billion-dollar windfall and a failed acquisition attempt. Regulation and government oversight add another layer of complexity. Takeovers can attract scrutiny from antitrust authorities, labor unions, and international regulators. Governments worry about monopolies, job losses, and national security implications, especially when foreign corporations attempt to acquire strategic assets. Navigating this regulatory environment requires expert legal advice, lobbying power, and patience. Some takeovers fail entirely because of regulatory pushback, showing that even billion-dollar strategies are vulnerable to political and legal realities. Corporate culture is often overlooked but can determine the success of a takeover. When two companies merge, differences in management style, corporate values, and operational methods can create internal friction. Employees may resist changes, clients may react negatively, and productivity can decline. Successful acquisitions often involve meticulous planning around culture integration, sometimes taking years to fully harmonize. This human factor, emotional, social, and operational, is as critical as financial strategy in billion-dollar deals. The ripple effects of corporate takeovers extend far beyond the companies involved. Competitors must adjust strategies, suppliers may renegotiate contracts, and investors respond to perceived market shifts. Entire industries can be reshaped virtually overnight. When one company acquires another, it sends signals that echo through global markets, influencing trade, investment flows, and even economic policy. Understanding this interconnectedness is key to realizing why corporate takeovers are more than business. They are a form of economic power in action. Hostile takeovers can spark drama, but even friendly acquisitions have hidden costs. Job cuts, shifts in company strategy, and loss of innovation are common side effects. The public often only sees the headlines, the deal size, or the stock movement, but the real impact is complex and often invisible. Communities, employees, and smaller investors may bear consequences, while the acquiring company and its top executives enjoy increased power and wealth. It's a reminder that billion-dollar moves come with human consequences as well as financial ones. Cross-border acquisitions add another dimension. When companies expand internationally through takeovers, they face currency risk, geopolitical risk, and cultural differences. Yet, the rewards can be enormous: access to new markets, new talent pools, and strategic global positions. Multinational acquisitions are carefully calculated moves where political acumen is just as vital as financial analysis. The biggest deals often involve countries, legal systems, and markets, making corporate takeovers a global chess game. Activist investors play a surprising but important role in takeovers. They buy stakes in a company and push for changes that increase value, sometimes pushing the company toward a sale or merger. These investors operate aggressively, using influence to reshape boards and strategies. Their presence can trigger bidding wars, force management changes, or accelerate takeover timelines. Activist investors are a reminder that corporate takeovers aren't just about the companies involved. They are also about external pressures, influence, and calculated intervention. Finally, the allure of billion-dollar paydays drives risk-taking at the highest levels. CEOs, executives, and shareholders often stand to gain enormous personal wealth from successful acquisitions. Stock options, performance bonuses, and equity stakes can translate into millions or even billions in personal profit. This personal incentive creates a high-stakes environment where bold moves, aggressive strategies, and even risky gambles are standard. The human desire for wealth, power, and influence is as much a factor in takeovers as market conditions or financial models. The hidden world of corporate takeovers is as fascinating as it is complex. It combines strategy, finance, psychology, law, and human ambition into high-stakes plays that can reshape industries overnight. Understanding these dynamics reveals not just how companies grow, but how economic power is concentrated, contested, and expanded. Billion-dollar acquisitions are not random, they are meticulously planned, expertly executed, and often invisible to the casual observer. They are a reminder that in the modern economy, power often lies in the ability to move fast, calculate risk, and act decisively. From hostile bids to friendly mergers, leveraged buyouts to cross-border expansions, the world of billion-dollar acquisitions shapes markets, industries, and economies. It's a world of risk, reward, and hidden strategy, where timing, information, and execution determine winners and losers. The next time you hear about a major acquisition, remember, behind the headlines is a complex world of strategy, ambition, and billions of dollars quietly changing the global economic landscape.